Microsoft beat earnings by $1 billion. Revenue came in at $81.3 billion when analysts expected $80.3 billion. Earnings per share hit $4.14 versus $3.91 expected. Azure, their cloud business, grew 39% year over year, and the stock dropped 12% in a single day, wiped out $350 billion in market cap. That's more than the entire value of Netflix. Gone in 6.5 hours of trading. So here's the question that should keep you up at night. How exactly do you win and still lose? I'm going to explain why Microsoft's earnings beat turned into a bloodbath and what it reveals about the entire AI infrastructure game. Because this isn't about Microsoft. This is about how markets price future expectations versus present reality, and why the companies spending the most money right now might be setting themselves up for the most painful correction later. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Imagine you're playing poker at a high stakes table. You've been betting aggressively all night. Everyone knows you have a strong hand because you keep raising. Finally, you flip your cards over. You've got a full house. Kings over tens. That's a winning hand in almost any scenario. But here's what happens. Everyone else at the table looks at your cards, nods, and cashes out their chips. They leave. Because they realize that yes, you have a strong hand tonight, but you've also been betting so much money that your future hands need to be even better just to break even on what you've already committed. And they're not sure you can pull that off. That's Microsoft on January 29th, 2026. Let me walk you through what actually happened in the earnings report, because the devil is in the details that CNBC doesn't have time to explain during a 3-minute segment. Microsoft reported revenue of $81.3 billion for the October through December quarter. That's up 17% year over year. Their intelligent cloud segment, which includes Azure, hit $32.9 billion, up 29%. Azure specifically grew 39%. On paper, these are excellent numbers. Most companies would sacrifice their CFO to Satya Nadella for growth rates like that. Wall Street analysts had modeled $80.3 billion in revenue. Microsoft beat by $1 billion. That's supposed to be good news. But here's where it gets really interesting. Azure grew 39%. Sounds great until you look at the previous quarter. Azure grew 42% in the quarter before this one, and 31% in the quarter before that. You're seeing a pattern, right? The growth rate is decelerating. Now, you might be thinking, hold on, 39% growth is still incredible for a business segment doing tens of billions in revenue. You're not wrong. But markets don't price what happened last quarter. They price what's going to happen in the next 12 quarters. And when you're Microsoft, trading at a price to earnings ratio of 30, you're being priced for acceleration, not deceleration. There's this moment in every analyst call where the CEO tries to manage expectations. On Microsoft's call, Satya Nadella said they're seeing strong demand for Azure AI services. Then came the kicker. He mentioned that capacity constraints would continue through at least the end of their fiscal year, which is June 2026. Translation: we could sell more, but we literally can't build data centers fast enough to meet demand. That sounds like a good problem to have, right? Sold out business. People begging to give you money. Except it tells investors something uncomfortable. It means that 39% growth might be the ceiling, not the floor, for the next 6 months. Markets hate uncertainty about upside potential. Now, let's talk about the number that really spooked institutional investors. Capital expenditures. Microsoft spent $37.5 billion on CapEx in this fiscal year. That's up 66% year over year, $37.5 billion. Let me give you context for how absurd that number is. In 2010, Microsoft's total annual revenue was $62 billion. They're now spending more than half of their 2010 annual revenue just on building out infrastructure for AI in a single year. Here's the thing about capital expenditures. They're not like operational expenses that show up on your income statement and reduce your net income. CapEx gets capitalized on the balance sheet and depreciated over time. So when Microsoft spends $37 billion building data centers and buying NVIDIA chips, it doesn't immediately hurt their reported earnings, but it destroys their free cash flow. And free cash flow is what actually matters to investors who aren't idiots. Let me show you the math. Microsoft generated $28.7 billion in operating cash flow last quarter. Sounds great. But they spent $11.4 billion in CapEx in that same quarter. That's roughly 30% of their operating cash flow going straight into infrastructure before they can return anything to shareholders. Now, project that forward. If CapEx keeps growing at 66% year over year, while revenue is only growing 17%, you've got a math problem. The gap between what you're earning and what you're spending is widening. That's the opposite of what mature, profitable tech companies are supposed to do. But you might be thinking, wait, isn't this investment in AI infrastructure supposed to generate massive returns down the line? Shouldn't we be celebrating that Microsoft is going all in on the future? Here's where the psychology of money comes in. Markets are forward-looking, but they're also probabilistic. When Microsoft spends $37 billion on AI infrastructure, they're making a bet. The bet is that this investment will generate returns that justify the capital deployed. But here's the uncomfortable truth. Nobody knows what those returns will actually be. Think about it this way. When Amazon built out AWS infrastructure in the early 2000s, they were creating a new market. There was no cloud computing market before AWS. So every dollar they spent was opening up entirely new revenue streams that didn't exist before. But when Microsoft spends billions on AI infrastructure today, they're mostly fighting for market share in an existing AI services market against Google, Amazon, and a dozen well-funded startups. The total addressable market might grow, but it's not a greenfield opportunity. It's trench warfare. And here's the kicker that nobody wants to say out loud. The economics of AI infrastructure might be fundamentally worse than the economics of traditional cloud computing. When you sell compute hours on Azure for traditional workloads, your gross margins are in the 60 to 70% range. You're selling virtualized infrastructure that costs you relatively little to replicate. But when you sell AI inference or training, you're burning through expensive NVIDIA H100 GPUs that cost $30,000 each and have a useful life measured in months, not years. Because the technology is advancing so fast, your margin profile might be 20 to 30 percentage points worse. Let me give you a real scenario to make this concrete. Let's say you're a portfolio manager running a $400 million technology fund. You own 2 million shares of Microsoft at an average cost basis of $400 per share. That's $800 million in a position that's oversized for your fund because Microsoft has been running so hot. Now earnings come out. Revenue beat by $1 billion. Azure growth decelerates slightly. Management guides for continued capacity constraints. CapEx is up 66%. You have about 90 seconds to make a decision before the after-hours market moves without you. Here's what goes through your head. Microsoft is priced at 30 times earnings. The market is pricing in continued acceleration. But you just heard deceleration. The company is spending money faster than revenue is growing. That typically compresses multiples. If Microsoft's PE ratio drops from 30 to 27, that's a 10% haircut on your position. That's $80 million in losses on an earnings beat. Your risk management system is screaming at you to reduce the position. So you sell 500,000 shares after hours. You're not alone. Every other institutional investor is running the same calculation. And that's how Microsoft loses $350 billion in market cap on a day when the actual business performed well. Here's the part that should terrify you if you own any of the mega cap tech stocks. Microsoft isn't special. This exact same dynamic applies to Google, Amazon, Meta, and every other company betting billions on AI infrastructure. They're all playing the same game. Spend huge money now. Hope the returns materialize later. Pray the market stays patient. But patience is not the market's default setting when interest rates are sitting at 4.5% and you can get a risk-free return in treasury bills. Picture this. You're at a Microsoft analyst call. Some junior analyst who got the question pre-approved, asks, "Can you talk about the return on invested capital for your AI infrastructure spending?" There's a pause. Then the CFO says, "We're confident that our strategic investments position us well for long-term value creation." That's corporate speak. For we have no idea, but we can't afford not to spend this money, because if we don't, Google will eat our lunch. Here's a dirty secret about AI infrastructure spending that nobody wants to acknowledge. A huge percentage of this CapEx is defensive, not offensive. Microsoft isn't spending $37 billion because they've calculated an exact ROI and determined it will generate sufficient returns. They're spending it because if they don't, they risk losing cloud market share to AWS and Google Cloud. It's an arms race, and arms races have a nasty habit of destroying returns for everyone involved. You might win the war, but bankrupt yourself in the process. Let's zoom out and look at the incentive structure, because that's where you find the truth. Satya Nadella's compensation is tied to revenue growth and stock performance. The board wants to see Microsoft maintain its position as a $2 to $3 trillion company. Institutional investors want continued growth to justify the valuation multiple. So what does Nadella do? He spends aggressively on AI infrastructure because the alternative is to look weak and defensive. He guides for strong future growth because that's what keeps the stock elevated. But here's the problem. Everyone knows this game. And when the music stops, when growth doesn't materialize at the rate required to justify the spending, the stock gets hammered. I've been running my own business for over 10 years. I've been in rooms with accountants and fiscal lawyers who explain how companies really work behind the polished earnings presentations. Here's what I learned. Companies optimize for quarterly results in stock price, not long-term economic efficiency. Microsoft spending $37 billion on CapEx isn't necessarily the optimal business decision. It might be the optimal stock price defense decision. Those are two different things. Now you're asking yourself, if Microsoft can beat earnings and still drop 12%, what does that mean for everything else in your portfolio? Here's the uncomfortable answer. We're in a market environment where expectations have outrun reality for a lot of big tech names. Microsoft was trading at a PE of 30. That's expensive for a company growing revenue at 17%. The stock had run from $344 to $555 in less than a year. That's a 60% gain. The market was pricing in perfection. And perfection is a hard standard to meet, especially when you're spending money at an accelerating rate while your growth rate is decelerating. The real insight here is about the gap between operational performance and stock performance. Microsoft, the business is doing fine. Revenue is growing. Azure is growing. They're generating tens of billions in cash flow. But Microsoft, the stock, was overpriced relative to the near-term trajectory of the business. And when reality catches up to expectations, the adjustment is violent and sudden. This is the part where most finance YouTubers would tell you to stay calm and think long-term and don't panic sell. I'm not going to tell you that because it's lazy advice. What I'm going to tell you is to understand the incentive structure of the market you're playing in. Microsoft didn't become a bad company on January 29th, but the market's willingness to pay 30 times earnings for a company with decelerating growth and exploding CapEx evaporated. That's information. Use it. Here's what you need to take away from this. First, earnings beats don't matter if the growth trajectory disappoints. Microsoft beat revenue by $1 billion, and it meant nothing because Azure growth decelerated. Markets price the derivative, not the absolute value. They care about acceleration, not just growth. Second, capital expenditure matters more than reported earnings when you're trying to value a business. Microsoft can show strong earnings while burning cash on infrastructure spending that may or may not generate adequate returns. Free cash flow is the number that doesn't lie. Third, when mega-cap tech stocks are priced for perfection, even minor disappointments trigger massive multiple compression. Microsoft lost $350 billion in market cap because investors repriced the multiple from 30 to 27. That's a 10% correction on a stock that was already expensive. If you own Microsoft, or any other mega cap tech stock betting billions on AI, here's a question you need to answer honestly. Are you owning it because the business fundamentals justify the valuation? Or are you owning it because it's been going up and you're afraid of missing out? Those are two very different investment theses. One of them survives days like January 29th, 2026. The other one gets destroyed. Look, I have multiple hundreds of thousands of dollars invested in the market, skin in the game. And days like this remind me why lazy investing built more fortune than crypto memes. Because when you own boring, diversified index funds, you don't care if Microsoft drops 12%. You own a tiny sliver of Microsoft alongside 3,000 other companies. But when you're concentrated in mega cap tech, because it's been the only thing working for 3 years, you're exposed to exactly this kind of violent repricing. The market doesn't care about your narrative or your thesis or your conviction. It cares about math. And when the math stops working, when revenue growth is 17%, but CapEx is up 66% and the PE is 30, something has to give. In this case, what gave was $350 billion in market cap in a single trading session. Microsoft will probably be fine long term. Satya Nadella is a competent CEO. Azure is a real business generating real cash flow. But the stock might be dead money for a year or two while the business grows into the valuation. And that's the lesson. Valuation always matters eventually. Maybe not today, maybe not this quarter. But eventually, price has to converge with value. And when it does, the adjustment is brutal for anyone who bought at the top thinking it's Microsoft, it only goes up. Stop confusing a good company with a good stock price.